Welcome to the Asian Connection Mortgage Podcast, where we connect Asian Canadians together to talk about anything related to real estate, mortgages, and finances, based out of Vancouver. Our host is John Lee, mortgage broker with the Rise Mortgage. Grab a bubble tea and enjoy the episode.
Welcome back to the Asian Connection Mortgage Podcast. I am John Lee. I'm going to be talking about a practical and easy rate reduction tactic that many Canadians can use if they have a hybrid mortgage. So it's often called a mortgage laddering strategy, and you're going to need a re-advanceable mortgage for this. So there's different names for it. I don't even know if there is a actual name for this strategy, but you may have also heard it as HELOC-to-fixed laddering or segment laddering. And the idea is simple. You use the HELOC portion to replace the higher rate fixed term, then lock those portions at today's lower fixed rates as new segments. And over time, your blended rate will fall. And this works really, really well in a decreasing rate environment like we are right now. So it's been a lot of talks about different strategies using hybrid mortgages lately. And I've received some questions like, what is a hybrid mortgage? I've never heard of this from banks. Well, it's because different banks call it differently. You may have heard products like the STEP program or Home Line or Flex Line or Home Power Line. So if you hear something similar like this, then very likely this is a hybrid mortgage or what is also known as a re-advanceable mortgage. Simply, the lender lets you split your debt into multiple segments. Some can be fixed, some can be variable, and very likely it comes attached with a home equity line of credit. So that flexibility is what makes the laddering possible. So here are a simple example. So say for example, like 2 years ago, rates were high, right? Remember, right after COVID, inflation was a huge issue and all of a sudden rates skyrocketed. Well, I was doing mortgages and they were around like 6%. But now rates are much lower now, around 4%. So you want to take advantage of the low rate, but you don't want to break the mortgage because you might need to pay a penalty on it. And whatever savings that you might get on the lower interest rate, it's going to get offset by the penalty. So this is where laddering comes in. So laddering helps you shift portions of your balance from the 6% to 4% without breaking the whole mortgage. So here's a real life example that I did that really helped a client. So the client's mortgage was 400,000 and it was at 6%. And good thing this client was smart because he knew that rates were really high. So he locked it in for 3 years. So a shorter term instead of five. But what he had was a large home equity line credit limit. The lender is Scotia, and they allow 20% prepayment annually as a prepayment privilege. So what he did was he took out 80,000, which is 20% of the 400,000 from the home equity line credit, and then locked it in into a 3-year fixed mortgage at 4%. So now the result is that 320,000 is at 6% and 80,000 is at 4%. And I just want to note that this has nothing to do with tax deductibility or tax strategy. I know I talked about that in previous episodes with the Smith maneuver and things like that. This works well for people who don't have a rental property or don't have a business. They just want the lowest rate at a given time, but they don't want to pay any penalty. So this is simply what we call an interest swap from one portion to another. So some people might ask, well, why don't you just refinance the whole thing? Well, you could, but then that means you're going to break your fixed rate term and you may face an interest rate differential penalty, which is a fancy name of super high penalty. Because generally penalties are calculated at 3 months interest or interest rate differential. And interest rate differential is often much higher than 3 months interest penalty, and it also kicks in when your rate is higher than the current rate. And laddering uses your prepayment room to uh, blend in these balances so you can control a lower rate, and also you don't need to break the cost. So this is the, I guess, the loophole or a special way of trying to get a slightly lower rate, but without causing a penalty. I know this does take time, it is slower, but it is cheaper and it's more flexible. So what are things to really watch out for? So number one is you gotta make sure you know what the prepayment policy is. Different banks are different. There are some that are 10%, there are some that are 20%. So just make sure you know what it is and also keep track. You don't want to go over it because if you do go over, you end up paying a penalty. And next thing to watch out for is to make sure you are allowed to convert your home equity line of credit into fixed segments. Most banks would allow you to do that, but it's just good to double check and how it works. There may be limitations on the term that they allow. Some they just go like, okay, minimum 3 years, and we're happy with that. There are some that are like, okay, well, there's still like 4 years left in your original term. So you can lock it in, but these fixed segments, you'll have to be at least 4 years or more. Now, last thing to watch out for, and to me, this is a pretty big drawback, and it quite turns me off to not proceeding with this. But if you don't care, then totally this strategy is good. So the drawback is that the whole point of laddering is to have different maturities, right? So then when you have different segments maturing, then that segment will be at the current rate, whether it's higher or lower, and hopefully it is lower. But because you have different maturities, you're guaranteed to pay a penalty if you want to bring your mortgage to another lender. The reason is because on paper, it might seem like, oh, I have like these different mortgages, but really it's just one mortgage, like one big umbrella, one mortgage with different segments. And unfortunately, you can't just decide like, oh, this segment number one, I want to transfer that portion to another lender. No, you can't do that. It's all or nothing. So because there's going to be one that's not matured yet, hence like the whole strategy, that portion will be prone to penalty. So be careful of that. If you love the lender, then I don't think it's an issue. But if you're one where this mortgage is actually not your home bank and you just got it simply because they were offering a promotion at that time, then maybe you might want to reconsider maybe switching it to a bank that you're doing most of your business with, so it's easy to like transfer money and things like that, and then implement this strategy. Let's go over some common questions. So one question would be like, okay, well, is this a second mortgage, third mortgage, fourth mortgage? So like I was saying before, this is just one big mortgage with different tiers. So to answer that, no, it's not a second mortgage. It is one mortgage. And how many segments are you allowed to have? Well, it really depends on the lender, so that's another thing to double check. Some allow like 20 segments, some allow just three. So ask before you convert so you can plan accordingly. And then last question is like, okay, fixed term lengths on these new segments. I mentioned this before. Yeah, many choose like 3 to 5 years, especially right now, 3 year fix is where the lower rates come in. But yeah, like some lenders will limit the length of the term. So just double check on that before you lock it in. So hopefully this explains how this strategy works. So just a quick recap. This is called a mortgage laddering strategy using a re-advanceable mortgage. It can be also called like HELOC-to-fixed laddering or segment laddering in Canada. The goal is to lower your blended mortgage rate and spread renewal risk without fully breaking your high rate term. And how we do this is to draw from your HELOC or home equity line credit, prepay the high rate segment within your allowance, and then convert the draw into a new fixed segment at a lower rate and just keep repeating it. And as a result, then more of your debt sits at the lower rate, your blended rate falls, and then your maturity dates are all staggered. So hopefully that helps you all out. And thanks again for listening to the Asian Connection Mortgage Podcast. So if you think mortgage laddering could help your situation, feel free to reach out and I'll be happy to show you. So if you enjoyed this episode, remember to like and subscribe for more clear strategies like this and send in your questions. See you next time.
Thank you for tuning in. If you enjoyed today's episode, please consider giving us a review and subscribing to our podcast on your favorite platform. Thank you for listening, and we'll see you next time on the